Welcome to another episode of the Capital Playbook. We are so happy to have you with us. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. And today we are so excited to be with you because we have a special guest, Mr. David Blatt of CapStack Partners. We're going to talk about debt funds today. We're going to learn a little bit how a debt fund is structured, how it adds value to its clients, and how you can benefit from the services of a debt fund depending what business you're in. But before we get into our conversation today, you know what we have to do. We have a little bit of housekeeping, and what we're going to do is encourage you to show us that you like us by hitting that like symbol on our little YouTube channel, and then also subscribe to show your support for us, and then hit that little bell so that you know when the next episode is going to come about. Now today we are here at the MBA conference, the Mortgage Bankers Association, and we're here because we're able to talk to folks like David, people that can give us wisdom about what's happening in the capital markets and how the capital markets benefit you. David, thank you for being a part of our show.
Thanks for having me.
Yeah. So, David, you've been in this space for a few years, in this debt fund space. Most people don't realize that debt funds even exist. They're so familiar with banks, and they're familiar with maybe credit unions, and maybe there's some agency lenders out there. What would you say is the difference between a debt fund and these other sources of capital? What problem do you guys solve in the industry?
So we're solving a few problems, actually, and for a number of different, I would define clients, like you're saying. So, as it relates to borrowers, the debt funds are coming to the table with typically a little more certainty in getting a loan through, because the underwriting guidelines generally are going to be much more flexible. If you're dealing with qualified debt funds, for the most part, what you're dealing with in terms of who's running the show there is someone who either has some background investing into commercial real estate or is viewing the deals through that lens, where if you take it in contrast with like a traditional bank or credit union or some of the more regulated type entities, they're really just looking at it as an asset class that they're getting exposure to, and it's a much more abstract kind of view. And, if anyone's gone through a bank underwriting process to get a loan done, it can be a bit onerous.
Right.
And sometimes, you might be having a conversation with a guy behind a desk who's never seen a piece of real estate necessarily and is really just looking at the numbers. So the debt fund really just offers up, just a very pragmatic, practical view on the deal you're buying, what you're building, and saying, okay, this makes sense. I'm willing to lend money on this. Let's get this done. The paperwork's typically a lot easier. You do end up paying more in most instances. How much more varies under the circumstances, but it's a capital solution. And for the most part, that's essentially what every investor is trying to solve for. And it's always good to know at least that it's in your arsenal when you're trying to get a deal across the finish line.
Yeah, and that makes perfect sense. There are so many folks that feel that banks or some of these more established institutions are the only way to go, but it may cost a little more in terms of interest rate, but there's usually a lot more value that a debt fund is able to offer, if it's the right circumstance, than a typical traditional lender. Would you agree with that?
I would say so. For the most part, the couple of just like easy elements of value, I've touched on, having a little more certainty of getting the thing closed. But you're also generally dealing with the same fund people or points of contact. And through the life cycle of the loan or the deal that you're in, as opposed to just kind of getting, passed off to, let's say, an 800 number or, the servicer, which is very disconnected and
Right.
it's just sort of following the guidelines of the loan that you've gotten done, if you've successfully gotten it done. The other element of it is, should things come up, you also have someone on the other side who can think practically about the circumstances to try to get to a solution. If the issues that are arising obviously are not, a result of anything you've done or not done according to the deal that you put on the table on the front end, right? But to that end, it's always good to have someone, again, practical on the other side that says, okay, let's solve this problem.
Right.
All right, you're trying to get this from point A to point B. I want you to get it from point A to point B. What do we need to do that or get it back on track in order to have that successfully get to this point B?
Yeah, yeah. So now, as a fund manager, you generally have multiple clients that you're serving, in that you're satisfying and taking care of the needs of your borrower, and then you also have to balance that with your concerns for your investor and your fiduciary responsibility to them. What do you do to manage that?
So I would throw into that, just within the nature of our fund, that lenders themselves are
They
one
would
of
be
our
considered your
clients.
clients, right?
Yeah. So, and we're trying to serve everybody as best as we can, for the most part. But the way that we look at it is very simple. We're trying to solve problems all around the table. That's the general approach. So with our investors are participating in our fund because they're interested in getting access to real estate debt, whether it's performing or distressed, because we do both. And they want to create a cash flow stream through that. So we're trying to solve that for them and do it as risk appropriate as possible,
Right.
to be able to do that. With borrowers, the obvious is that they're trying to capitalize deals. And so if we're getting involved in a deal that is on the front end of an origination, like a performing loan, then we're trying to facilitate that so that they can get there. And also trying to pay attention to structure, right? It's as much about the money and the structure, because just having the dollars in a structure that is kind of boxing you in as a borrower,
Right.
could be problematic. And very often those investors don't really think that through until they're post-close, and then suddenly it dawns on them as to what that certain term or
Right.
condition or process means. And they become really smart about that really quickly, and maybe learn for the next go around what they're sensitive to based on the next deal, hopefully. And then for us, a big client, I would say, is our lender relationships. And so with our lenders, we're doing a lot of business, and really that's really who our counterparty tends to be in our fund, because our lenders send us a lot of loans that they cannot do for whatever reason. So either they're a traditional bank, or perhaps they're just, not sized appropriately, or they can't do a particular type of asset, or, work in a particular part of the country. And so they'll send it to us because we have a lot more flexibility being a debt fund. So we'll solve for that. Alternatively, if they're doing a loan, but they can only go up to a certain leverage point, we'll come in and fill that gap behind them. So we'll do some mezzanine or junior position. And then, otherwise, very often they are looking to, let's say, exit out of particular loans for whatever reason, then we'll be buyers of that. So those could be performing loans of a particular asset class, or they could be non-performing loans where they just want to move them off the books. So, in all respects, we're really solving problems all around. And that's how we've built our business.
Oh, okay. Well, that's great. So that distressed debt fund model is something you're very familiar with, because that's kind of how you kind of cut your teeth.
Yeah.
Tell us a little bit about your personal or your professional background and experience that led you into operating a debt fund.
Sure. So I began my career. I always wanted to be in the real estate investment space. This is going back like 20 years or so. And when I started to look around and figure out where my entry point was, I was just meeting with people in the industry, just to pick their brain, build my network, and really just wanted to be thoughtful about how I entered into the
That was
industry.
very, very smart. Yeah.
It was very eye-opening because
Right.
if you're familiar with real estate, you know that you can wear many hats in this industry and still just create wealth. It's just a matter of choosing the on-ramp that speaks to you and where you think you're going to excel the most.
Right.
So I actually at the time ended up starting my first job working for a real estate developer that was doing redevelopment of environmentally distressed properties. And the way that I got that job was that it was a small shop, and it was two partners. They were looking to hire a receptionist. And
So you started as a receptionist.
I started as a receptionist, and this is coming out of, I'd already gone through law school
Wow.
and business school and in graduate school, but it was fine because I really just, I went
You're
to,
looking for an on-ramp.
that's it.
Right.
I looked at it and I said, this is an apprenticeship
Right.
for me. And when I presented the offer to these guys, I said, listen, you can pay me what you were going to pay the receptionist. I want three things out of this deal. I want the ability to learn this business from you.
Right.
I want the ability to build my contacts. And I want the opportunity to maybe earn some equity in some of the deals that we do.
Wow.
And the absolute condition that you need to be prepared for is once I feel like I've gotten a full understanding of this, I'm leaving.
Right.
So as long as you're okay with that, I'm okay with this job.
Right.
And so they hired me, and I was there for a couple of years.
I think you hired them, but go ahead, finish your story.
It's debatable. So I left after just a couple of years,
Right.
and I started my own shop. I started doing one-off syndications. I started in the distress space right away just because
You understood the business.
I did understand the business.
Yeah.
I realized also that environmentally distressed was a very small niche that I was not going to be able to sustain
Right.
deal flow, but just general distress worked, and I really liked the idea of coming in where, if you look at the classic supply and demand, seller wants the highest price, buyer wants the lowest, and where you meet in the middle is the trade.
Right.
So when you're buying a distressed asset, and particularly a loan from a bank, it's buyer wants the lowest price, seller wants to get this thing off their books.
Right.
So your motivations are different.
Right.
And I liked that
Right.
because I thought I could buy value.
It's hard not to lose, if, because you win when you buy it.
Right. Right. And it's funny because the way that I frame it is that, you make your money on the buy.
Right.
So to that end, I really liked that business, and I wasn't competing necessarily at the time, and I started to build that up. We had investors, and that started to scale, and the market started to get a little frothy, but it was still way early on before the big meltdown. But we had built a platform of just deals
Right.
in the distress space, and we had some high net worth family office investors, and it wasn't a full-fledged fund just yet. And then, just like I would say, before the meltdown, we formed a fund, and I would say just when everything started to just go downhill, I was able to actually go out and start raising money from a lot of these private equity groups that were looking to put money to work right away into distressed deals.
Because they knew there were a lot of distressed deals coming to the market.
Right, exactly. And so because I had the infrastructure and the track record and everything else, I was able to raise money into this fund, and we had a really strong run, through the recession until about like 2012 when the market came back and there wasn't really much distress to chase.
Yeah.
So,
But you did see an opportunity then, because the credit boxes of banks had shrunk quite a bit at that time.
oh, tremendously so. And so I would say I formed CapStack Partners, which is my current company, and I didn't just jump in right away. I just wanted to get a lay of the land, just see where the capital markets were trending.
Right.
And so for the earlier part of the company, I was doing a lot more work with banks, really in an advisory role where I was helping them partner up to make loans happen because the capital markets were not fully open and up and running yet.
Correct.
So I was able to bring in a lot of the lenders that I'd known now for like 10 years and jump into some deals with them and do participations to really solve for the financing.
Right.
Because they make their money on putting money out.
Right.
Borrowers needed the money to make the deals happen.
Right.
And so that started to scale. And along the way, we also were able to identify distressed deals here and there from lenders, who just send us these things because they knew that I had the background and I'm in the space. And it got to a point where I was able to sustain a fund by doing both, which was different than just the distressed fund. And admittedly, I waited around for what I thought was going to be a shift in the market cycle where I could start another distressed fund, but that hasn't materialized even now.
Right.
But this suits better because it's a lot more flexible.
Right.
And it really just aligns with this concept of utilizing capital to solve a real estate investment problem that everybody around the table has. Right. Everybody wants a deal to happen because everybody, in theory, will make money on that deal. Right. The lender who's either putting the loan together or selling it, the investor who's in our fund, and the borrower who needs that money to buy the deal that they're buying.
Yeah, absolutely. So it's interesting. I guess looking back, you probably thought about this when you came up with your name, CapStack, because as you speak and talk about your mission and how you add value, basically what you're doing is looking for areas throughout the capital stack where you can add value. And that's the role you play. So you're not necessarily just in that distress space, but if you can come in and fund a portion of the deal or bring the right partners together or participate at the right level in that deal where it creates value for you and your investors, that's the role that you play. So you're very flexible. Do I have the right sense of that?
That's absolutely correct.
And so when you came up with the name, is that what you thought?
Yeah.
Wow.
That's exactly it.
I mean, what foresight? Because I say that because of the fact that, when lending started opening up 2012, I remember it greatly. I was avoiding foreclosure. No, but it had tightened up quite a bit. And if you're in the money business and your sources of capital have dried up, you're having to try to figure out a new business model. And it seems like that was the perfect timing for you. Because you started CapStack in 2012?
That's right.
And that's exactly when a solution like that was needed. So how has your company performed from 2012 to now?
It's done really well.
Wow.
And I think a lot of it just has to do with exactly what it is that we do.
Yeah.
I really enjoy solving that end of the business. I mean, I understand the operational elements of being in real estate. I understand the development side, the management side. I do get that part.
Right.
But the part that gets me excited is solving for the capital structure.
Right.
And I think it's also a function of if you look at the evolution of real estate finance, it's always just been like, the traditional, I'm going back, but like rich guy with some money goes to his bank and gets a loan.
Right.
The end. And now it's evolved and continues to evolve. And there's just so much more room to really get creative because, what I think a lot of people, at least implicitly understand, is that you have constituents around the table that are trying to solve for a bunch of different things.
Right.
And what's great about real estate as an asset is it's big enough of a pie that you can slice it up to really address all of those interests, right? You can't do that with any sort of commodity or something like that, right? There's just not enough zeros, frankly.
Right.
Right. But when you take a real estate asset, there's room to figure out, okay, you're going to be in the safest position, but you're going to earn this. That's okay. That's what I'm trying to earn. I'm the bank. Right. You're going to be under there. You're going to earn a little more, but you're also still safer than the guy at the very bottom of that. Right. And then the bottom of the stack is the investor. Well, you get access to all the ups.
Right.
Because you're the first guy to get crushed if things go wrong.
Right.
So there's that kind of trade-off. And then, you can figure out all sorts of variations on that inside of that. And that to me is always very interesting, because then you introduce different kinds of priorities and profiles. And then it gets into like, well, is it a debt fund? Is it a bank? Is it a life insurance company? They're all trying to solve for different things with the money, even though they're providing a loan to the borrower. And I think borrowers would do well to think about what's under the hood.
Yeah.
Right? Because I think that'll actually make the conversations better, because then you get the motivation, right?
Right.
What's this particular lender trying to solve for with their money?
Exactly.
And so like life insurance companies want longer term.
Right.
You have debt funds are typically shorter term.
Right.
So that kind of driver also will help you. There are borrowers out there who are just like banging on doors trying to raise money for deals without thinking about like who they're talking to when it's like a DOA conversation. Right. They're just talking to the wrong guy.
Right. Their interests are not aligned.
No, they're just like, I need money. I need money.
Yeah.
Right. And
the two things, they need money and they want the cheapest interest rate, and have given no consideration to designing a proper capital acquisition strategy for the asset they're trying to finance.
Right.
And so as a result, because of that, just that singular focus on interest rate, they miss all the opportunities to create value for themselves by executing this transaction. And as a result, because they're so focused on interest rate, they don't even look for guys like you. But you're the guys that can really add value to what they're trying to do.
I would agree with that. I think that thinking about smarter money, or even thinking about, when you start on the top end of the stack, right, and you're comparing bank money to more expensive money, you're anchoring yourself in the wrong place, right? Because equity is the most expensive money. And if you're using OPM, right, to get the deal done, right, then you're paying the most. And not only that, but you're basically having someone who has no exit.
Why is that so difficult for borrowers to understand that?
Well, because when, equity has no structure to it. So it almost feels like you're not paying anything.
Right. But you are.
Right. But then when the deal goes well, which it should, and you expect it to, right? Well, someone's now going to be along for the ride for the life of this deal, unless you can affect some kind of buyout, which is challenging to get somebody out when you haven't
made all the money, right?
When they're like, no, I want to, I'm staying in until you stay in, right? So, maybe you're paying a little more in interest, but maybe the source of that debt is going up a little higher, right? And every dollar that they're now giving you is replacing the equity. So it's in fact cheaper money in total. But when you started at my bank down the block is, half the rate, you're right. But, you just got to think about what your total capital cost is. Right. What's that total capital cost on a blended basis? And also, is it strings attached money or not?
Right.
So, there are those considerations. And I think people do tend to get fixated on, let's say, one component to their detriment.
Yep, and that's why we see deals fail. And we're like you. We're in the mez space business, and because of that, we we do well because clients hadn't really thought about the right senior debt to put with their mez. In those loan covenants and their loan agreement, they've not given consideration into negotiating. They love negotiating when it's in foreclosure. but negotiating at the beginning where they should be, they tend to fail in doing that sometimes. I'm sure you found that to be the case in your experience as well. Huh?
It tends to be so, because again, I get it. Very often investors are just like, look, I got to get this deal done.
Right.
Are you going to give me the money?
Right.
Is it going to be there at the table? Yes. Okay. And then the rest can get overlooked. Which is why, post-close, you suddenly realize structure starts to matter, right? It doesn't have to be distressed, for you to realize, oh, wait, I got to send you reports.
Yeah.
I got to deliver, X, Y, and Z, or, whatever that might be.
I can't get that draw until I do it like this, and it still may take me 3 weeks. It has to be signed
off. Right. Wait, you have to sign off? Yeah. I need to know you're spending the money appropriately.
Right.
This is the process by which we do it. Well, I have a problem with that. we've closed the loan now. You didn't raise that before.
So now, since the last economic crisis that we went through, there has been literally a plethora of debt funds that just pop up all over the place. What would you say would be your competitive advantage for the customers you serve that you offer? What's that? If you were to point at your key value proposition that you add, what would you say that is?
I think that it comes down to a couple of things: the structure of our fund,
Okay.
and just being practical minded. So a lot of lenders are very, call it, boxed as to, what it is they'll look at. And I get it. It makes it easy to understand,
Right.
what to bring them, or, what it's going to cost, or, just those parameters. And we provide those guidelines. But, they're guidelines. And so, for us, we start at who the person on the other side of the table is.
Yeah.
That goes across the board.
Yeah.
Investor, lender, or borrower that we're going to be dealing with, because
Right.
it's a business relationship.
Right.
Our fund is open-ended, which means it's evergreen. We don't have an exit as to how we conduct our business.
Right.
And so we can think long-term about those relationships, because our investors are putting that money in. They just want to see this perform. We want to find things that are going to perform, and we want to have good counterparties with whom we're going to do deals to be able to achieve that with that mindset.
Right.
So there's that element of it as well. So to be able to have a reasonable business conversation to essentially get whatever it is that everybody needs accomplished, I think is a big differentiator. So that's been a key component of where I see us differentiated from a lot of these debt funds. And, I would say secondarily, we keep everything on our books. They're our loans.
Right.
And so there are a lot of funds who, just buy to sell.
Right.
And for them, you're just feeding the beast, and so you're an input to an output.
Right.
With us, we're thinking about every deal like a loan relationship. And so to that end, we're really just considerate. Again, it comes back to who we're doing our business with, because we're going to be there. We expect them to be there.
Right.
And as long as everybody performs, this is going to be successful all around the table.
Yeah. And I think another area, just in hearing your story, your background, how you entered into the business, you are a real estate expert, and that's not true of every debt fund. Some debt funds are good at trading debt, but you understand the real estate business. And I think that's one of the things that really allows you to come in at those various levels in the capital stack with an eye on solving problems and adding value to your clients. That's just my personal observation.
It's true. That's why we always look at, when we're coming into the stack, and, whether we're a junior position, senior position, we always describe it as, where we are in the risk, part of it is our last dollar in.
Right.
Right. So I often express our loan as like, okay, we're buying this deal at this price point.
Right.
The borrower's buying it at their price point. But I'm expressing it like we're buying that deal at our price point, because I'm thinking about it like, look, I could potentially own this real estate. I need to know that.
You have to understand your exit.
And I need to be comfortable where I am and think practically, like, I may have to run this thing. And am I okay with that? Because I understand this business. So that's exactly right.
Yeah, absolutely. So if you were to give advice to mainly, I don't think we have a lot of lenders watching our podcast, but we certainly have a lot of prospective borrowers. And if you were to give them advice on how they could properly prepare themselves or prepare their deal to do business with you, what advice or recommendations would you make?
So I think that it's really just, thinking about who your counterparty is, right? Meaning on the lender side, and what it is that they're trying to accomplish, right? So it's to make the deal with you.
Right.
So your motivations are aligned. That's a plus.
Right.
Right. So what will get them really comfortable that your motivations are aligned is that you're thinking about the things that they're going to need and being able to be responsive to that, right? So, we're getting to know each other.
Right.
I need to know all the stuff about you as a sponsor, right?
Right.
So it's like the typical checklist stuff about like your background, your track record, your financials. Having those things at the ready sends a message outside the information itself that you were anticipating the lender requiring that. And it just says, okay, I borrower, I'm on top of my game.
Right.
I know what you need. Here it is. We can talk about things I can supplement, but I've already anticipated that you're going to obviously need this to get comfortable with me. You don't know me.
Right.
So here's everything on that end. Information on the project itself that you're trying to get financed. It's just about having that package as ready as possible before you go out asking for the money and someone says, I think I could be interested, and then starting to cobble that together in advance. I think that goes a huge way in just sending an implicit message that you're a professional at what you do and understand what your counterparty and future partner, ideally, who is going to give you most of the money to take this deal down, is going to require to get comfortable with this, right? And it'll ultimately translate into better negotiation leverage, flexibility, and a much smoother, faster close, ideally, for everyone involved, because everyone wants to get there. So I think that's a big deal. And what I would say, not necessarily to be a better borrower per se, but, I think that what I've learned through my experience investing in real estate, because I invest in the debt side, but I'm an investor, just like other real estate investors, that I think that investors can think about getting into opportunities on an investment side through debt versus necessarily going out and buying the real estate. To me, it's a very similar proposition. It's just a different place to play. I will say it'll be very eye-opening to be on that side, because you're going to get that perspective. If the thing performs well, I think a lot of people will get lit up on that and probably stay on that end of it. But you can move to either side.
Yeah, a lot of people don't consider that. It's interesting that you say that. We have a business model in our company that we have in play, and I won't talk about it because part of our strategy. So, but it's interesting that you say that. But that's a conclusion that we've come to. Is you can be that owner of the asset and own those leases, or you can be the owner of the asset and own the notes. And there's some compelling advantages that we found in that structure. So
absolutely, it's a risk reward trade off, right? Where it's you can say this is an acceptable capped return for the risk of how much I put into this and the structure under which I put it. Right. So it's just another approach again to real estate investing. And look, certain deals, I participate in other people's deals on the equity side. I take deals down on the equity side if it makes sense to do that. And, I can tell you, I'm a great borrower. I'm a great borrower. And I take pride in being a great borrower because I have such a full understanding of what that other side of the table is like. And so it makes it so easy for me to get the loans done and to understand that process. And that just gives so much comfort to the lenders that I do business with as a borrower because of that fact. So I think that it just, it broadens out your own expertise if you're truly trying to be a real estate professional and build wealth in the space. And it'll just give you so much flexibility where you'll start to identify real estate investment opportunities and say, okay, you know what? I don't necessarily want to be buying this thing, but you know what? I could finance it.
Yeah, absolutely. Mr. David Blatt with CapStack Partners, where we are so happy that you decided to stop by. Are you enjoying San Diego?
Oh, very much.
Yeah. So all the way from Miami to San Diego, Thank you for being on our show, and would love to have you on our show again in the future. But the information you provided, absolutely great information, and I'm sure the folks in our audience are going to enjoy this episode. Join the conversation. Make sure you subscribe to our channel. Allow us to attract the talent, the expertise like Mr. Blatt onto the show. And that way you get some real advantages out of this. So like, subscribe, and share. Thank you again for being a part of the Capital Playbook.